For decades, the real estate industry has benefited from generous tax deductions that raise home values by making it cheaper for people to own property and shoulder their local taxes. Now, as the Republican tax plan makes its way through Congress, the industry is worried that the fallout will harm its business by making home ownership less valuable. Around the country, real estate organizations are calling legislators, warning clients about their future tax bills and staging protests, all in an effort to keep homeowners as a favored class in the tax code. "We don't consider ourselves to be Republicans or Democrats," said Linda J., Chief Executive of the Bakersfield Association of Realtors in Central California. "We are the Realtor Party." Last week, Ms. J and other agents congregated in front of the local office of Representative Kevin McCarthy, the House Majority Leader, holding signs and chanting, "Save homeownership." "We know he has a tough job to do," she said. "But we certainly are not going to shy away from letting him know what our feelings are." According to some economists, real estate agents have plenty to fear. The Senate version of the tax bill would eliminate the deduction for local property taxes. The House bill caps it at $10,000, and both the House and Senate bills would effectively make the mortgage interest deduction less valuable to many homeowners. Both provisions could raise the cost of owning a home, making home ownership less attractive for at least some families, and perhaps depressing property values. In addition, the tax plans would increase the time it took homeowners to qualify for an exclusion from capital gains taxes owed when they eventually sold their homes. That would most likely reduce transaction volume, the bread and butter of agent commissions, by encouraging people to wait longer to sell. Like just about every aspect of the tax plan, these measures would fall hardest on people who lived in high-cost, high-tax areas. According to an analysis of the plans by Moody's Analytics, the nation's most expensive real estate markets could see significant declines in home values under both versions of the tax plan. "There really are big winners and losers here," said Mark Zadet, chief economist at Moody's Analytics. "If you live in New York or New Jersey, you are going to get crushed. If you're in West Texas or Nebraska, no big deal, and you may even benefit. In New York and New Jersey, which have expensive homes and high property taxes, home values could fall as much as 14% by 2019 under the Senate plan, according to the Moody's analysis. The suburbs around Chicago, Cleveland and Philadelphia are also near the top of the list. Those figures are estimates, so should be viewed with some degree of skepticism. Still, they reflect a fundamental truth: the tax code subsidizes home ownership, and that has raised the value of homes. All else being equal, removing those tax breaks should reduce home prices. Some economists are skeptical that the tax bills would have a major impact on the housing market. Matthew Poynton, a housing economist at Capital Economics in New York, said the bills could lead some well-to-do families to buy somewhat smaller homes than they otherwise would.